At this point in time, I do not own Cochlear shares. And in fact, I have never owned Cochlear shares. And whenever I've done research on this company, there has been actually two things that have been holding me back. And the first thing is just the lack in growth in revenue. And what I'm looking for is growth above 10% per year. And we'll look at the revenue growth of this company later in the video. And the other thing is the valuation. Now, there is a seemingly premium attached to Cochlear because it is a high quality company. That is what the market believes, that Cochlear is a high quality company. And for high quality companies, typically there is a premium attached to the valuation. And that's definitely true for Cochlear. We'll also have a look at the valuation later in the video as well. And those are the two main reasons I am not a Cochlear shareholder right now. If we see a significant decrease in the share price from where it is right now, and I am talking about fairly significant, that's probably the only time I would think about taking a position in this company. The second reason, another possible reason I might consider taking a position in this company is if I start to see sort of an acceleration in revenue growth. And we aren't quite seeing that quite yet with Cochlear. For those who don't know, who have been living in a cave, Cochlear provides hearing implants and also hearing implants accessories. So 57% of the revenue comes from Cochlear implant systems, 31% from sound processors, upgrades and accessories, and 12% from bone conduction systems and sound processor upgrades, which is acoustics. We'll talk about that in a second as well. Now, I have heard some people explain why they're bullish on Cochlear. And the main reasoning is when someone gets a cochlear implant, they keep on spending throughout the rest of their life. So Cochlear sort of locks in that patient and then they just bring in a lot of cash through the rest of life because they have to do sort of upgrades, accessories, and those sort of things. But just because that sort of business model is there doesn't necessarily mean Cochlear is a good investment right now at current prices. Even though I've done a little bit of research on Cochlear in the past, I dug a little bit deeper for this particular video, and I found it quite fascinating that Cochlear is the go-to hearing implant for newborns. In fact, they have a greater than 80% penetration for children under 3 years old. That addressable market is about 130,000 people. So they are the go-to when we're talking about that sort of population, children in developed markets. When you're talking about adults and seniors in developed markets, they only have about 3% penetrations, and that addressable market is about 6 million people. So this is the area I'd like to see Cochlear sort of address and try to get a better market share moving forward. The other place I'd like to see the company get a better market share is when we're talking about emerging markets. And right now, children in emerging markets, they only have a penetration of less than 10%. And that addressable market is significantly higher than children in developed markets. I think the main thing holding Cochlear back is just the cost. So I would assume there is a significant cost for newborns to get the cochlear implant. And more than likely, parents are more willing to pay for a cochlear implant for their newborn children than they are probably for themselves. And that's why I think Cochlear is the leading and go-to hearing implant for children under the age of 3. Another thing they are aiming for is acoustic implants, the next generation bone conduction hearing solution. Addressable market, greater than 3 million people in developed markets, and at this point in time, less than 1% penetration in this area. So there are potential roads for significant growth for Cochlear in the future, but we're not quite seeing that just yet. The current CEO of Cochlear is a guy called Dig Howard, and I think his parents wanted him to be a CEO of a mining company, but he went in a different direction. He's also the president and managing director of the company. And one thing I do like about Cochlear is the CEO and the CFO, or CTO actually, have been in with Cochlear since 2000. So we're talking about 23 years. And Dig Howard was appointed to the board on the 14th of November 2017 and he's been the CEO and president since the 3rd of January 2018. So I do like the very fact that there is stability when it comes to the management of Cochlear. One position I do focus on in companies like Cochlear is the Chief Technology Officer, and for Cochlear, that is Jan Jansen. And just like Dig Howard, he's been with Cochlear since 2000, Senior Vice President in 2005, and CTO in 2017. He leads 500 engineers and scientists. And the reason I believe this is a highly important role is because the future growth of Cochlear is going to be highly dependent on how these 500 engineers and scientists and Jan Jansen identify and develop new technology. And at this point in time, Jan Jansen actually holds 10 granted patents in the field of implantable hearing technology. So we don't know, maybe in 1 or 2 years, Cochlear could have developed a new implantable hearing device that will totally blow away every other competitor and even blow away all the other products that Cochlear has. And then you will see significant growth in the company. I probably would classify Cochlear as a high quality company in terms of what they do. So in terms of the company itself, but as a business, as an investment, I'm a little bit hesitant to put Cochlear into that high quality realm. And there's one reason I probably am a little bit hesitant about that, and that is around the revenue growth. And we'll talk about the revenue growth later in the video. Now into the financial year 22 results. We'll also have a look at the half year results as well, though the Cochlear released the half year results, if I remember correctly, on the 15th of February. I'm recording this video on the 24th of February, so about 9 days ago. Now, the current share price is around about $225, but at $224.53, the market cap of Cochlear is about $14.8 billion. They had $1.65 billion of revenue in financial year 22, $289 million of profit, $351 million of operating cash flow, and $307 million of free cash flow. If we just compare the market cap and profit, we can see straight away that the valuation of this company in terms of P/E ratio is quite high. So times that profit by about 50, you get to a market cap of around about 14.8. And a P/E ratio of 50 might be okay for a company that is growing their revenue and their profits at a pretty strong rate. So that is the main question we're going to have for Cochlear moving forward. Can we justify the current valuation with a P/E ratio of about 50 based off their revenue and profit growth? So let's have a look at the revenue growth. The first thing I always focus on when I research a company is the revenue growth. And typically, I want to see revenue growing at 10% per year. It doesn't have to grow at 10% every single year, because some companies will have some better years and then some worse years. But generally, over time, I want to see revenue growing at least 10% per year, because that is the best predictor of a company's outperformance from the market. I'll just say that again. Revenue growth is the best predictor of whether a company can beat the market or not. And companies that are growing their revenue at more than 10% per year typically outperform the market. Research has been done on this. And for Cochlear, so I am looking at revenue per share, not just revenue, I'm looking at revenue per share. And over the past 10 years, Cochlear have grown their revenue per share at 7.2% per year, which is a little bit less than I would like to see. And actually, in fact, you can see between 2010 and 2014, revenue was flat. And then it started growing, and we had really nice growth between 2014 and 2019 before that pullback in 2020. And when we look at the chart, you'll be able to see the share price mirror the lack of revenue growth between 2010 and 2014, and then also mirror the really good growth in revenue between 2014 and 2019. Over the last 5 years, revenue per share has only grown at 1.4%, and over the last 3 years, 0.5%. And I think one of the main reasons behind that lack of revenue growth in the last 3 years is simply because of COVID-19. We did see some good revenue growth in the past year, and now we'll have a look at the half-year results just to see if that revenue growth has continued. So that's in the next slide. But before we have a look at that, the other thing I like to look at is margins. And typically, I like to see margins at least remaining steady, if not improving through time. Can't really say that with Cochlear. So in this particular slide, we're looking at operating margins. Back in 2010 and 2011, this company had the best operating margins, about 30%. Then it dived back in 2014. This company did go through some problems, 2013-14, can't remember exactly what, but margins or operating margins fell from 30% down to 19%. They were climbing between 2014 and 2019. So this company had pretty good revenue growth between those 6 years and also had some margin growth as well. But those margins have pulled back over the past few years. And the worst year by far was 2020 with margins down to 16.6. Margins right now are around about 23%. And I think this company could grow the margins in the future. So if this company goes back to their growth profile we saw between 2014 and 2019 and also improve their margins, I think you could argue that a P ratio of maybe 50 is not too extreme. Now onto the company's half-year results. So the first thing I always look at is revenue growth. Now the problem with half-year results, it's only 6 months, and a company can have a bad 6 months, and I'm not necessarily going to hold a company to task if I do see revenue growth less than 10% in half year, or even less than 0% in half year, because then the next half year they could turn things around, or maybe the company has experienced 10% revenue growth over the previous 3 years. But we haven't seen much growth with Cochlear over the past 3 years, and I would like to see revenue starting to get above 10% per half year or 10% per year. So for the half year, Cochlear grew their revenue by 9% or 7% in constant currency, which removes the impacts of foreign exchange. Now, that's okay, not quite 10%, the level I am looking for, but margins did decrease during the half year. In fact, underlying net profit margin fell from 19% to 16%. So even though revenue did grow, profit actually fell for the year from 158 million to 142 million, which was down 10% or 6% when you're looking at constant currency. And of course, underlying earnings per share fell from $2.40 to $2.15, which means if you look at the trailing 12 months, the P ratio of this company is actually more than 50 now. It's actually gotten higher than what we have seen based off the financial year 22 numbers. The company also announced on-market share buyback, and this is where I do have a little bit of problems, because I would probably argue that right now Cochlear is overvalued with a P ratio of greater than 50, and yet we're not seeing that growth to justify that sort of valuation. And in my opinion, this is my opinion, the only time you do a share buyback is when the valuation of your company is below where it should be, because you are creating value for your shareholders in that sort of situation. In this sort of situation, you are buying back your company's shares when they are overvalued. You're not creating value for your shareholders. Now, one of the reasons they're doing a share buyback is because they believe they have excess cash. So net cash of 505 million on the 31st of December. Now that net cash expected to reduce by approximately 170 million following the acquisition of Oticon Medical. So for some reason, they've just decided to do a share buyback. But typically I like share buybacks when the company is undervalued. And this is sort of the capital allocation, capital management decision that I do look at to determine whether a company's management is high quality or low quality. So this is not the sort of move I'd like to see from a company at this point in time that Cochlear find themselves in. Cochlear also provides a dividend to the shareholders, and another sign of a really high quality company is when dividends grow for every single year. Maybe not every single year, but you like to see growth in dividends. Don't really see that with Cochlear. In fact, dividends haven't grown all that much from 2013 to 2023, so sort of going flat. So this is not the sort of dividend profile I like to see for a high quality company. Dividend yield 1.3%. So you're not buying Cochlear for any sort of income at this point in time. And that's probably another indication that this company is, there's premium to the company valuation, P ratio of greater than 50, very low dividend yield. And that is concerned when you don't see dividends growing all that much, which sort of aligns to the lack of growth in revenue. Probably shouldn't say lack of growth in revenue, but revenue is growing at a slower rate than I would like to see for a company with a P ratio of greater than 50. Now onto some valuation metrics, and this is where it gets really exciting. Whenever I'm researching a company, I like to hone in on the valuation metrics, particularly if I do discover a high quality company and then I see the valuation metrics really low, say P ratio less than 10 for a high quality company is amazing. For Cochlear, the P ratio right now, based on their financial year 22 numbers, so not even including their financial half year financial year 23 numbers at this point in time, but the P ratio is 51.2. Price to sales ratio 9. Price to operating cash flow a little bit lower than 51.2 or the P ratio, but at 42.2, that is really high. Now, when I do valuation metrics, I always like to do a reverse DCF. I prefer reverse DCFs over DCFs because I just want to see the sort of growth a company needs to justify the current valuation. And I went down the conservative approach and just looked at the earnings per share. So the company, Cochlear, would have to grow their earnings per share at 27.4% per year to justify the current valuation. Now, with revenue growth over the past 10 years of only 7%, that means either the company will maintain or can maintain that 7% growth in revenue, but simply, amazingly, I don't know how, increase their margins so they get more profit out of that revenue, or this company would have to grow their revenue at a significantly greater rate than 7% per year. So at this point in time, I don't see how, unless there's some new innovation from the company where they can, gain more market share in some of those markets where they don't have much market share at all, much penetration. I don't see how this company can achieve a 27.4% increase per year in earnings per share over the next 10 years. Now, you could argue with me that Cochlear always has a premium attached to their valuation because it is a high quality company. Well, that's what the market thinks anyway. This is a high quality company. But I probably would assume that with that good revenue growth between 2014 and 19, the market got a little bit ahead of itself. Not only did there was financial expansion during that time period, but there was also multiple expansion. So this is the P ratio history for Cochlear going back to 2013, so 10-year history. And in fact, there was multiple expansion between 2014 and 2019. In fact, at the start of 2015, the P ratio of Cochlear was about 30. And in fact, we haven't seen the P ratio get below 30 since then, apart from 2020 when they were not profitable. That's why the P ratio goes all the way down to 0. So we ignore that. But the P ratio has been climbing ever since then. So between 2015 and right now, there has been multiple expansion for this company. P ratio has climbed from 30 to almost 60. In fact, the peak in P ratio for this company was 60 back towards the end of 2021. So whenever you see a period, and this period of multiple expansion has been going on for 8 years, you just do have to be a little bit wary because the best way for a company to grow their valuation in the future is through a combination of financial expansion and multiple expansion. And when a company goes through a long period of multiple expansion, the likelihood of that multiple expansion continuing for the next decade is going to be quite low. And I think more than likely what we're going to see over the next decade is a period of multiple contraction. Potentially the P ratio of Cochlear will go from 50 to 30. And even if the company undergoes a period of financial expansion, even if they see revenue growing at 10% per year, the share price might not do anything. So at this point in time, with a high valuation, there are a lot of risks moving forward for Cochlear, and wouldn't be surprised at all where we don't see the share price in Cochlear move higher for the next 10 years. Unless, of course, there is some sort of innovation that the company brings to the market, and that innovation is substantial. And then we see revenue growing at, say, 20, 30% per year. I've already mentioned the period between 2014 and 2019 was good for the business. That's when they had really good, consistent revenue growth. There was also a really good period of multiple expansion. You can definitely see that in the chart for Cochlear. So this is the weekly chart for the company going back to 2010. And between 2010 and about 2015, share price went sideways. So during that period of time, if you remember that revenue growth, there was none at all during that period of time. So the market wasn't in love with this company. And then the market fell in love with Cochlear between 2014 and 2019. In fact, the share price went from $60 to a high of $250. So a four-bagger in that, was it 6-year, 7-year period. A nice, beautiful uptrend in their share price, which mirrored the nice growth in revenue, also mirrored the multiple or that period of multiple expansion. But since the share price did reach that high back in 2019 or started 2020, share price has really done nothing. In fact, there's been a lot of volatility in the share price over the past 3 years, and this is a period of time where we just see the share price go sideways, and it could continue for a while yet, just like we saw between 2010 and 2014. And as we hone in on the daily chart for the company, this goes back to about February 2021, and I just wanted to include the highs we saw back in July of that year because the share price of Cochlear had been in a downtrend. And that downtrend is portrayed by that downward sloping dashed line. And you can see the peaks in the share price hit the downtrend perfectly about 3 times in the past year, or just over a year, actually just on a year. So it hits that downtrend line back in April last year, also in August last year, and then again at the start of December. And each time the share price hit the downtrend line, we saw the share price pull back. But in January of this year, just a month ago, the share price pulled above that downtrend line. So the downtrend in the share price of Cochlear has been broken, and you could even argue the share price has moved in to an uptrend. So just based off the chart, ignoring valuation, everything like that, you would actually say this could be at least a short to medium term buy. Over the last few days, I have been preparing the next video in this series, which is on XRF Scientific. Share price has popped up because they released the half-year results and the market liked it. Share price closed at $1.07 on February the 23rd, which is an all-time high for that company. And then the next 4 videos will be on Dicker Data, Index, Centuria Industria Property, I think CIP, which is really going to be the first pure REIT I'm ever going to look at, and Goodman Group. That's all I have for this video looking at Cochlear. So even though I do believe, in my opinion, this is a great Australian company around what they do, but just because it's a great Australian company doesn't mean it's necessarily a great investment at this point in time. So there's 2 things holding me back from taking a position in Cochlear. The first thing is the valuation, P ratio of greater than 50, is a little bit too high for my liking, particularly when the revenue growth over the past 10 years is less than 10%. Now, just because it's been less than 10% in the last 10 years doesn't mean it's going to be less than 10% in the next 10 years. This company could grow at more than 10%, and maybe if they do, with increasing margins, that's when you could justify the current valuation. But I'm not sold that this company can grow or increase their growth in the next decade. If you disagree with me, I'd love to hear your thoughts. Why you like Cochlear right now as an investment. So if you do like Cochlear right now as an investment, I'd love to hear your different opinion. So leave that different opinion in the comment section of this video. Otherwise, I am not an investment advisor. If you do need investment advice, make sure you seek out someone who is qualified and can speak to your own specific needs. That's it for this video. Have a good day. Bye.